What you know and what you may know about conventional loans. Lots of things going on. One of the most popular loan programs that's out there, but we're here to dive into a little bit of both. So we have Tracey here with Hancock Whitney, as always, being able to break down all that fun stuff. So Tracey, let's start with basics. What is a conventional loan?
A conventional loan is a loan that's not backed by the government like an FHA or D or VA loan is. It's offered by private lenders, typically backed by Fannie Mae or Freddie Mac guidelines.
So those are typically those banks, it's typically those banks that end up getting bought, Fannie Mae, Freddie Mac, that's like the overall.
Yeah, they right. Those follow those guidelines. And this product, conventional, is typically for clients who have higher credit scores, lower debt to income ratio, stable income. That's typically who we put in this loan product.
So what is the minimum down payment or the down payment look like?
Okay.
I think most people think of conventional, they think about
20%. Right. I don't have 20% down. I can't go conventional. And that's not true. So if you're a first time home buyer, you may qualify for as little as 3% down on a conventional loan.
Which is super helpful because that's actually a little bit cheaper than an FHA loan, which is 3.5%.
FHA requires 3.5% down. So you may be able to squeak by with 3% down. The more common number, especially if you're not a first-time home buyer, is 5% down. Now, what happens with a conventional loan, if you put at least 20% down, that negates the need for PMI or private mortgage insurance. So that could save you a little money. But what sounds super weird is PMI mitigates risk for the lender or the investor. So
it almost sounds like it's counterintuitive, right?
Yes. So in some situations, if you have MI for a short period of time, in other words, like if you put 15% down and have MI for a few years, the rate may be a little bit better, sometimes by 1/8 to 1/4 of a point, because that mortgage insurance mitigates risk for the lender, the investor. So it's like an insurance policy for them against default.
So does that almost offset sometimes the
It can, yeah. The total monthly payment, yeah, it can in some situations. And then once that MI drops off, so in a conventional loan, once you reach 20% in equity, the mortgage insurance should drop off, and then you're left with that lower payment. So yeah, and MI isn't super expensive, especially if you have high credit score and high down payment. The more compensating factors you have, the lower the mortgage insurance is.
So is it possible, kind of beating the system, so to speak, would be, 15% down, work through a certain amount of time? Is it possible that something like that could work? Obviously, you'd have to run the numbers for folks to be able to see that. So maybe pay in the note over the course of a year, put the remainder of the 5% down to be able to have it fall off.
Yeah, they can. Yeah, you may be able to, like a catch up.
Yep, a catch up.
Yeah. So the guideline, the law states that if in order for PMI to drop off early, instead of according to the amortization schedule, you have to have made adequate payments, adequate on-time payments. So I can't measure adequate. So what I've seen with most clients who've been in that scenario is about 12 months of payments. And if you've reached that 20% equity, you can call your—
Seems adequate.
Yeah, you can call your the mortgage company and request that they take a look at your file and drop that mortgage insurance.
So it automatically drops off at 78%?
Yeah, at 78%, it drops off no matter what. That's the law. Now, if you call and you're at 80%, then it would drop. Now, I've seen it where the investor, the mortgage company, has dropped it at 80%. So it just depends on who you're making those mortgage payments to.
Gotcha.
Yeah.
Well, thanks so much for kind of getting all that cleared up. So what you had mentioned, better rate, better debt to income, all that other fun stuff.
Yeah.
What does that look like?
So in conventional versus FHA, for example, if you had like a 780 credit score, that's going to give you, a better rate than a 640 on conventional. So typically with conventional, we want to see at least a 620. It may be harder to qualify 620. The rate's going to be a lot higher. The mortgage insurance is going to be a lot higher. So that's why we shift to a government-backed loan like FHA. With conventional, think in 20-point increments. So the higher your credit score, the better the rate, the better the mortgage insurance. So 780, 800, that's when you get in your prime time for low mortgage insurance, low rates.
And one of the things, and for folks out there, one of the reasons that you hardly ever see Tracey talk about, your rate today is blank, is one of these factors. There's no knowing exactly what everybody's credit score that's watching videos. There's no way to know what the debt to income ratio happens to be, and all the other mitigating factors that'll kind of make the rate go up or down based on your scenario. So it's always best to be able to go and fill out an application so she can have a much more fruitful conversation about what your needs happen to look like.
Yeah.
That way, we can actually dial in and figure out what scenario makes the most sense for you.
Right. And some people may think, oh, well, RD is the right loan for me, or conventional is the right loan for me, but everybody's situation is completely different. So I like to look at the complete application, find out what your goals are, and then put you in a program that makes the most sense for you. Someone who qualifies for conventional may also qualify for FHA, and FHA may be the better deal. You just don't, depends. Yeah, it just depends. So I always try to help my clients navigate the what's and the whys on choosing a product that works best for them.
I like to look at this as, the application's kind of like letting a doctor know what your symptoms are, and then she can actually fill out the prescription for you that makes the most sense for your needs.
Yeah, good analogy.
Perfect. Where can they find you?
Tracey.Lasair at HancockWhitney.com.
We will see you guys next week.